Welcome to QAV AU, TK. This is the 1st of July. Happy new financial year, Tony,
Yes.
2025.
Happy New Year. There is
Before we
only
get
the
into the
financial.
happy,
There is only the financial year. We
that's
don't
the
need
only
to say.
that's the only year you
Yeah,
care
Happy
about.
New Year.
And unlike recent years, this has been a pretty happy end to the financial year for us.
Yeah.
End of financial year report. Dummy portfolio finished up nearly 20%. 19.87% for the financial year versus the STW up 13.61%, according to Navexa. Great year for the index, but DP not quite double, but pretty good. My super portfolio not as good. It was up about 13.5%. My QAV light for the financial year, all four portfolios grouped together, was up 15.17%. So beat the index, but only by a couple of points. Interestingly,
hang on. I know what you're doing there to group all the light portfolios together, but how many stocks is in that grouped portfolio?
Yeah, well, it'd be 60-ish, 40 to 50 to 60, yeah.
So it's kind of
I know it gets close to
hug the index.
Yeah. It's one of the problem with the groups, yeah.
Mm.
I can break them out, but I haven't bothered. I'll do that in a minute. Here's the interesting thing. The Stockopedia US portfolio for our financial year, the last 12 months, was finished at 28.5% up versus the S&P 500 up 13.63%. Exactly the same as the STW in Australia, 13.6%. What are the odds of that?
That's very strange. And the S&P 500 wouldn't have dividends accumulated either, would it? But the STW does, I think. So the capital appreciation will be different. Yeah.
That's true. According to the Financial Review, it said the ASX ended up 10%, best year since 2021. So I guess we have to say thank you, Donald Trump, for just doing such a great job of
providing us with
running the
heaps
US
of headlines. Yeah.
Why don't you give us your results and I'll break down the light results while you're doing that.
Yeah, so I'm using ShareSite, which is a bit different to Navexa, but should be the same in terms of reporting. My performance was 17.85%, so not quite double market, but beat the index, which was lovely.
And you're still sitting on like 5 or 6 stocks?
Yeah, I think I've got 7 from memory.
Wow.
So it's concentrated, which is a good thing because my best performer, Parenti, is up 65%, including dividends over the course of the financial year. So,
wow,
works well when you have a stock like that in a concentrated portfolio. My worst stock was MMS, Macmillan Shakespeare, which I think I sold during the anyway, I'm not sure. It was down 15%, and a couple of the other ones. I've got some Bank of Queensland in there, which I'll include, even though it's was bought because Jenny was a board member, which she's resigned from. But it's on the buy list now and it has been on the buy list, so I'm happy to include it. It was up 50%. QBE, the insurance company, was up 31%. And PRU, Perseus Mining, the gold miner, up 18.7%. Interesting one was Super Retail Group, SUL, up 15%, but that included a 12% dividend yield. So that's mainly dividends, which, because I've held it for a while, now on a yield basis, taking over well and truly from the capital performance. So it's been a good year for the portfolio.
Well, congratulations on that. I've got the breakdown for the individual light portfolios and they're very varying. 22.1, our first portfolio is up 9% for the financial year, as was 22.2, up about 8.7. So they underperformed. 22.3 was up 16.4%, and 23.1, the last portfolio, was up 24%.
Wow, what drove that?
That was PRN. There's quite a few. Parenti was up 69%, SRG was up 68%, SSM was up 60%.
Wow.
KOV was up 34%. So it had, a handful of good winners this year. But the others did not. But the dummy portfolio's best performer was SRG, up 79% for the year.
Wow.
Also PRN, SRV up 47, KOV up 34, CVL up 27, PPM up 23. It had a lot of really good, dummy portfolio's got 1, 2, 3, 4, 5, 6, 7, 8, 9 stocks that were up over 20% in the financial year, plus another couple, KSC and IGL, that were up 19% for the financial year. So, just a bunch of great winners.
Mm.
Some of which I think we've held for quite a long time. SRG we only bought in August last year, so wow. All of them, what a great year it had. PRN, bought that in May last year. So anyway, there you go.
Very good.
So I did jump on QAV Club Facebook page earlier today and asked people to share their financial year performance with us, and nobody did yet. So thanks for that. If anyone wants to share your performance with us over the course of the next week or whatever, can share it privately or publicly. But yeah, let us know how you did. We want to know how you performed. Oh, hold on, here we go. Trent did get back to us. Good on you, Trent. Solid back-to-back returns with QAV hitting 21% this year. Once again, surprised at how much divs made up of return, which was boosted this year due to capital returns and special dividends. He calls out HLS and PPM. Currently hold 15 positions, fully sold 11 over the period, so a fair bit of turnover, but was spread across the year, not all around Trump Liberation Day. Over the financial year, I've held 26 stocks and 15 have positively contributed to overall return. Biggest rule break of year was partial selling some winners, which has negatively impacted return, as both are now higher than when I sold. Well, congratulations good on you for being honest, confessing. That's confessional. This is our QAV confession season. But there you go.
Good. Well, thanks for sharing, Trent, and well done. That's great.
Yeah. So if anyone else wants to share your results with us, we'd love to hear more. Hopefully everyone had a good year.
Alrighty. How about a pulled pork?
Do your pulled pork.
Yeah. GR Engineering Services, code is GNG. Now, I couldn't find it on our pulled pork list of stocks we've covered, but I think I may have talked about it years and years and years ago. But anyway, I'm going to go over it today. It didn't ring too many bells with me. It's possibly because, like a lot of stocks in our buy list, it's in the engineering services field. So we have a number of stocks I've covered in that space, and this is one of them. ADT is $380,000 traded per day, so it's a reasonably large stock. It will suit a lot of listeners. Based in Perth, but it does have offices in Brisbane, Indonesia, and it operates in Africa, and it also has a subsidiary in the US based in Tucson, Arizona. It was called Hanlon Engineering, but it's now under the GR Engineering Services banner. From their website, GR Engineering is a leading engineering, consulting, and contracting company that specializes in providing high-quality engineering design and construction services to the mining and mineral processing industries. The company's services cover all aspects of the project lifecycle, from the initial evaluation and study phase through to design, construction, commissioning, and operational support. So we've seen companies like this before. They're mining services companies. GR Engineering specialize in mine feasibility studies, design and construction, project management and consulting. They also have a division that provides similar engineering services to the oil and gas industry in Australia and Southeast Asia. I guess one thing that might differentiate them a little bit is that they often provide fixed cost or fixed maximum price uh, solutions when they're tendering for business. And they often do turnkey solutions to construction projects as well. They operate a number of different brands, and their sub-brands include MIPAC, MIPAC, and Paradigm Engineering. And they tend to be, they are leading providers of control systems, operational technology, and engineering services in the mineral processing, iron ore, and energy sectors. The process controls business delivers control systems, automation, and digital solutions for key clients such as First Quantum, BHP, Rio Tinto, Glencore Technology, Octedi, and other smaller conglomerates. So not only are they doing feasibility studies on mines, then building the mines or the processing plants, but they're also providing engineering services to the processing side of the business. So not just helping to dig iron ore out of the ground, for example, but also processing it before it goes overseas. So that's GR Engineering in a nutshell. The share price has been doing well lately, and it tends to bump up when they announce contract wins. And they've had a number of those in the last 6 months, including on the 20th of June this year, so last week basically, or 10 days ago, they won the contract for engineering, procurement and construction for the expansion of the existing Eloise copper processing facility in North Queensland for AIC Mines. The contract value was $77.6 million, including provisional sums. That sort of caught my eye because AIC is also a QAV stock. The code is A1M. And on the day that announcement was made, the stock jumped 7.3%. Likewise, in April, they won a contract from Horizon Minerals, HRZ is the code, and that was to do engineering studies work to support the refurbishment and repurposing of the Black Swan processing plant for gold production. Likewise, the stock was up over 3% on the day of that announcement. And back in September, they announced that they had been awarded a $25 million contract to upgrade and recommission the Woodlawn processing plant for a company called Develop Global. And the stock was up 5.3% on that announcement. So this is something to be aware of. I guess if you're interested in looking at this company to purchase, it's going to be news-driven and driven a lot by contract wins. The stock price has also been moving up when they've announced their results, and their most recent half results for December 24 were strong. So revenue for the half up till the end of December 24 was $272 million versus $187 million for the second half in 23. So ending December 2023. Net profit was $21 million for the same period versus $14 million. Earnings per share was 12.68 cents for the most recent half versus 8.5 cents per share a year before. So all of those contract wins are having a material effect on the bottom line for the company. And in their half-yearly announcement, the MD said, during the 2025 second half, net cash flows from operating activities was $56.1 million, which resulted in a cash balance of $111.8 million at 31st December 2024. The higher cash generation, nil borrowings, low capital intensity, and excellent project delivery all contributed to the maintenance of a robust and stable balance sheet. So that's, a few ticks there from the quality side of things. And lastly, just to look at the last 5 years, the share price has gone from 86 cents up to $3.25. So nearly a fourfold increase over the last 5 years. So it's been doing very, very well. It's been on the buy list on and off for a long time over those 5 years. So people may already be aware of it, may already own it, but certainly doing well. The numbers, the QAV numbers, I'm using a price of $3.25. And unfortunately, that's 29% above the consensus target, which we don't often see, but also above the IV1 of $1.16 and IV2 of $2.06. So the price is getting fully valued. The yield is 6.15%, which is above the average mortgage rate at the moment, so it scores for that. Stock Doctor Financial Health is strong and recovering, so we scored a 2 for the recovering side of things, and I like to see that. Stockopedia quality rank is 93 for quality and overall 98, so it scores well in Stockopedia. The F score is 7 out of 9, speaking of F scores, so very good. What also caught my eye in looking at the numbers was the ROE for this company is nearly 60%, 58.9%. So that kind of echoes the comments that the MD made about the company being capital light. So not just the tech sector, which is capital light, this services company is also capital light, strong ROE. PE at the time of the last results was 13.3, which was not the highest or the lowest. The current PE is a little bit higher than that, and if we scored it on that, it would be negative. It is just outside the range, but at last results at the end of December, 13.3. PropCAF is 5.71 times, so even though on a PE basis it's getting up there and on a valuation basis it's getting up there, it's still throwing off lots of cash, and on a PropCAF basis is well within our guidelines. Net equity per share is only 44 cents, and they've got some goodwill from acquisitions, so the NTA is only 27 cents, so we can't buy this company for anywhere near book or book plus 30. Interestingly enough, in the download from Stock Doctor, which I used, they have a negative forecast earnings per share of minus 9%. So it gets a negative 1 for growth over PE. But I find that conservative given the pipeline of work the company's announcing and given the strong results recently. I'd be surprised if it didn't increase its earnings per share going forward, but Stock Doctor may know something more than we do. Directors hold 11% of the company, including the owner-founder, Giuseppe or Joe Totaro, who owns just over 5% and has had 40 years of mining engineering experience. So we score it for an owner-founder. Shares have been rising for quite a while, so it's not a recent 3-point trend line upturn, so we can't score it for that. Equity is lumpy and not consistently increasing, so we can't score it for that. Overall, I'm giving it a 9 out of 13 for quality, which is 69%, and a QAV score of 0.12. So it may drop off the buy list if the share price keeps rising, because it's getting close to the bottom now. So, people, if you're interested, have a look. It may not be there if the price keeps rising in a little while. On the risk side of things, it's a mining services company. So if mining has a downturn or if commodities have a downturn, then the pipeline may dry up. They do, though, on the processing side, have a lot of recurrent clients. So they are diversified away from just getting tender wins to build mines. So that's a good thing. But a mining downturn will obviously affect them. And they are reliant on contract wins to keep their full-time engineering staff effectively utilised. So I think their business model is to hire a couple of hundred engineers and then put them to work. And if they don't have the work, I'm not sure how quickly they can get out of those contracts. But that would be a problem if there was a quick and sudden downturn in the mining industry. I'm also going to highlight the fact that even though this might be an advantage for them from a client point of view, but as we've seen in the property development world, fixed price and max price contracts may have difficulty if there are rising costs, which they have been over the last couple of years. Hasn't been called out as a problem, but may be a problem if inflation, keeps driving the costs higher, or there are other problems with costs increases and they're on a fixed price contract. So that may be a risk for them going forward. The strengths are the balance sheet, plenty of cash, plenty of PropCAF in a capital light business. The owner-founder is very experienced. And as I said before, repeat business on the processing side. So that's GR Engineering. Have a look.
Thank you, TK. And I can tell you when you last did it as a pulled pork. It was November 2022.
Right.
Episode 543, The Mounting Yard. So there you go. Don't know why it was called that, but that's the last time you did it. GNG. We don't hold it in any of our portfolios, I can report. I think we have at some point, but we don't right now. Speaking of portfolios, I was wondering why the light portfolios 221 and 222 underperformed so badly. They had a couple of deadly ones. They both held AMI, which dropped 30% or so the other day, which took the wind out of their sails. And the 221 also held HLS. People
Mm.
may recall that dropped suddenly, Helios, not too long ago. So
There was a
it's
capital
interesting
return
how,
with Helios, though, so you should have got the capital back into the portfolio.
yeah, I'm not sure how that shows up in Navexa
Mm.
though, honestly. So 221, let me see. Helios. Yeah, capital gain down 33%, income return up 41%, total
Mm.
return 8.38%. Yeah, so we came out of it at a profit despite that. But in terms of the performance capital gain wise, it took the wind out of its the portfolio sales.
Hmm.
Um, so it's interesting to me, like if I'm looking at the winners versus the losers in 221 versus say 231, which had a 24% return, it's not that much difference. It's like one or two stocks really that perform well or don't perform well, and that can make a big difference. So, because 221 for the financial year had a couple of really good ones, right? It had AMA up 69%. It had WGN up 65%. RRL up 35, MLX up 35, BFL up 31, but it didn't have three over 60%. you know, it was missing that one or two that would have maybe kicked its performance up as well as 231. Anyway, it's interesting when I look at its performance though. To the 221 portfolio up at January. Well, not even yeah. By the beginning of February, it was down 1% for the financial year. It went from in August it was down 5% already for the financial year. As of January, it was down 1% versus the STW was up 11% at that stage already. So it was underperforming by 12% in January. From January to the end of the financial year, it caught up. It ended up finishing 9% up versus 13.61. So the second half of the financial year, it actually did quite well despite Helios and AMI, which is a big one. If I look at the beginning of June, 221 portfolio was up 12.61% for the year versus the STW up 14.3%. So it was catching up. And then it had AMI just gutted it, knocked it down. So,
Mm.
you know, luck of the draw.
Well, yeah, luck of the draw, but it should even out over time. It's the same process being applied, just
Yeah.
different
I
starting
mean,
dates. Yeah.
yeah, different years. I mean,
Mm.
some years one portfolio does really well. I
Mm.
remember 222, which underperformed this year. If I go back to like a couple of years ago, previous calendar year, yeah, no. Remember there was one year it was up like 25% for the year. Can't remember which year it was because it had a couple of big winners.
Mhm.
So yeah, this year not so well. But over time, if I look at it, yeah, all time it's outperforming the index only by a few points, 11% up 8. Yeah, but it was up 25%. April 2023 it was up 25% versus the STW up 4% over the same period of time. So, yeah, has some good years, has some average years, has some bad
Mhm.
years. So keep telling people it's sort of the long haul thing, right?
Absolutely.
Great years, good years, bad years, average
Mhm.
years. just waiting for that really good year where you do 30-40% return, and it just sort of puts the wind in the sails for the next few years until you get another great year.
Correct. Yeah, very much so.
Patience,
Hmm.
Padawan.
Well, and the nature of the beast is we don't know when that good year's coming. Be great to know when it was. You pack up and travel the world and come back and invest when that good year was about to happen. But very
Yeah.
hard to predict.
And I think it's the hardest thing for new investors like myself years ago to appreciate is it's not doubling the market every year.
Hmm.
It's one really good year if you stick to a disciplined investing system, buying undervalued stocks and holding them as long as you can. You get one really good year, and that sort of takes care of the rest of the years. You just got
Hmm.
to
And as we're also
keep
seeing
building.
too, you get dividends if you hold those stocks long enough, where the yield becomes important, and the yield itself can outperform the index.
Yeah, right.